I guess what I want to say here is, it's a bit of somber news with what's happening in California, but I do want to lighten it up a little bit and take people's minds off that. So I'm going to ask a very serious question, and that is, does anybody remember Where's Waldo?
Yes.
I can't see hands in the room, so I'm assuming everybody my age has got their hands up, and everybody who's like much younger than me doesn't have their hands up. um, so in Where's Waldo, you would open a book, you would look for Waldo amidst the crowds, and on each page had a different theme. So it might be the police station one day, might be the supermarket the next page. Um, Today we're going to play a variation of that game. It's called Where's Alpha. We're going to look into the private markets. We're going to look into public markets. We're going to look into commodities, real estate, space, military, crypto. We're going to look all over for this and see where we find it. So that's the game we're going to play today. And while I'm having a little fun with the Where's Waldo theme here, I do have some very serious panelists who spend their days combing through the noise of the market to help their clients find alpha. And these people include Elliot Trexler, Chief Investment Officer for Global Return Asset Management, Alan Snyder, founder and CEO, Shinnecock Partners and aShareX, Tyson Halsey, who we're still waiting on. I don't see him yet. And then finally, Maureen Downey, who was there in person, and she's going to be my eyes and ears. So if people have questions or you want to ask them, just raise your hand and Maureen will let me know that you're here with a question to ask. And of course, Marty's always good that way too. My name is Mark Heil. I've been involved with alternatives since the mid 90s in marketing, capital raising, fund administration, and helping investors use their retirement funds to tap it to get into alternatives. I'm currently a managing director with Pickwick Capital Partners, a FINRA registered advisor to the middle market companies and alternative asset funds, providing specialized strategic and transactional services. We provide a full range of investment banking and placement services. Currently, some of our assignments are working with security defense companies, including a roll-up, a real estate owner operator of value-add workforce housing, a fund manager that has a value-add farm aggregation strategy, storage company, dual-use coatings company. So those are all just some samples and gives you sort of like the breadth and mix of what we have. Tyson, it's good to see you join us. You're right on cue. We're just about to dive into the disclosure and then self-introduction. So our disclosure is this panel is for educational purposes and not to be considered tax, legal, or financial advice. To the extent that one of us offers an opinion, it's our opinion alone and not necessarily the firms we represent. For the next hour or so, we're going to have a great conversation up here. We invite our audience to join us. The only request we have is, keep your questions short. Time is valuable here, and we want our panelists to be able to answer them quickly and fully for you. So if you can keep them short, if they need context, they'll ask you for additional information. And with that, I'd like to have our panelists introduce themselves. And Elliot, I'm going to start with you. If you could just give a minute on your background and what you do at Global Return Asset Management.
Great. Thank you, Mark. Hi, everyone, and good morning. I apologize I couldn't be there this morning. I had something come up, and also want to express the sentiment of everyone in Los Angeles. Global Return is an alternative investment company. I started in 2013. We have an 11-year net CAGR of 24.1%. That does exclude our cash balance because we've maintained a pretty healthy cash balance over that period of time. We launched a new algo on July 1st, and it is an advanced quantitative automated algorithm. Between July 1st and actually, I'll tell you a little bit about Global Return. I've never used off-the-shelf software, so no Bloomberg Terminal or Capital IQ. I've always worked with APIs directly into the SEC, pulling structured data. On July 1st, we launched the second algorithm, and between July 1st and July 31st, We significantly outperformed the S&P 500, the Russell 2000, and the Russell 3000, not only on a absolute cumulative basis, but also when you look at all of the metrics such as Sharpe ratio, alpha, Sortino, and R squared. Happy to be on this panel and look forward to answering everybody's questions. Thank you.
Fantastic. Thank you, Elliot. Maureen, since you're there live and in person, I'm going to ask you to do the same. Just give a quick introduction of yourself and let people know who you are and what you do.
My name is Maureen Downey. I'm currently with Beneficient Group. I'm a managing director. My career in the last 20 years has really spanned all types of alternatives. So I've been an allocator to primary funds across the board, both developed and developing markets. I've also been doing secondaries for about 20 years, co-investments and directs. With regards to secondaries, have done it across all asset classes. And in the last 6-7 years, I started doing it directly into late stage private growth companies. And so I was a portfolio manager for a 40 Act fund. So I can talk pretty broadly about the entire alternative asset class, as well as where I've seen kind of evolutions in terms of private market products. But I think also more in particular, some of you may be familiar with this, in the last, I would say 4 or 5 years, you've really seen the rise of high net worth and ultra high net worth getting a lot of attention from many of the asset managers out there now. And so there's a lot more interest in starting evergreen products. So with that, I'm happy to answer any questions. And I think I'm kind of the private markets person or alternatives person on this panel.
Looking forward to your comments and thoughts there, Maureen. Thank you. Alan, why don't you take the reins here and introduce yourself? Tell us a little bit about what you do, and then tell us about aShareX.
My checkered past was I grew up on Wall Street and ran the product areas for a big securities firm, started the Discover card with a couple of other people, got bored, and eventually left, started a small investment boutique, a family office, if you will, called Shinnecock Partners. Generally, I start lots of companies. And one of the ones I started was an insurance exchange. Eventually, battered and bruised, it grew. We became the largest seller of auto and home in the United States. And to my delight, Allstate said they wanted it. So we disposed of it to Allstate. The company Answer Financial still exists. And most recently had the temerity at my youthful age to start yet another company called aShareX, which we can get into when as and if Mark tells me to.
Fair enough. Great introduction. Thank you. And Tyson, why don't you tell us a little bit about yourself and Income Growth Advisors, and then launch into a quick opening presentation here.
Okay. Tyson Halsey. I'm a managing member of Income Growth Advisors, a registered investment advisory here in Charleston, South Carolina. I started working on Wall Street in the early 1980s on the floor, became a CFA. I've had a couple of hedge funds, run a couple of RIAs, and I've learned a lot over the years, having been involved in pretty much all aspects of this business. And what I'd like to do is just share my presentation, which is right here, because I think we're at a very interesting time. I think my experience, can everyone see that?
Yes.
Okay. Let's see. I want to set it up as slideshow. We'll go from the beginning. So I was on the floor before 1987. I learned a lot about program trading and the like, and markets moving quickly. And this reminds me a little of 1987, but the bigger theme is the Great Rotation. What I think is going on now that people who don't have a long-term perspective don't realize is the degree to which rising interest rates are creating competition now for equities. There's so-called Fed model or the risk premium model, where you take the 10-year US Treasury and you compare it to the earnings yield of the S&P 500. Right now, you get about a 780, you get about a 480 yield on the 10-year US Treasury, and the earnings yield on the S&P 500 is about 5%. So really, you're almost getting as much of a risk-free yield as you're getting by taking the risk to going into the equity markets. And it has been worse, but we're at a point which is starting to get us back to that bubble in 2000. And I think people need to take that risk very seriously. This is a great model. It helped me buy the market in 2008 and 9. I didn't do that much here. I definitely bought the hell out of it in 2020 when you had that COVID collapse. But right now it's telling us, no, you don't want to be in equities, not in a big way. I mean, I'm not saying that they die tomorrow. And here's an interesting consideration. That is, when you look at the S&P 500 and its PE yield, historically, you've actually, the following 10 years of returns have been in the -2 to 3% range. So Goldman came out with a piece, Bank America, and bottom line is the market's expensive, and historically things don't do well. And again, what the big issue here is that I think that there is recency bias. People got used to interest rates going down. Declining interest rates meant your bond portfolio always did well, and it helped drive your stock portfolio. That phenomenon is over. I don't know where interest rates are going, but there's a chance that it goes higher. And if it does, this will be like 1987. What's driving interest rates? Right now, we have huge debt. The debt to GDP ratio right now hasn't been this high since World War II. The interest on our debt is growing. It's about $1 trillion a year, which is bigger than our defense budget. Another factor that I think is important when thinking about where to put your money, I'm telling you, bonds don't look so great. Certainly stocks look pretty rich, is commodities. And historically, there have been these inflationary cycles, and these typically start after a stock market bubble. And I'm not going to suggest anybody in this audience was around in 1907 for that stock market bubble, so I can't speak with great confidence on that, but that's what the book says. 1929, stock market bubble, and then you wanted to be more into commodities as an inflationary environment. Then there was a bubble around 1970, that stock market bubble, that market peaked, and then you had a great period for oil prices. If you remember the Bass brothers, silver went through the roof, gold went through the roof. You also had another bubble in 2000, and the following 8 years, oil and gold did incredibly well. I think we are in another stock market bubble, and the place to be looking for value is going to include commodities. This market does remind me of the 2000 bubble in terms of the Magnificent Seven or the 10 largest mega cap companies. And I think that once the momentum starts to break, and it will break, and you're starting to see it with these increasingly higher interest rates, although today's data was encouraging on inflation, you're going to see more struggles in the equity market. And I took great I spent a lot of time after having made a great deal of money in tech in the 90s, that in the subsequent 8 years, had I gone abroad into the emerging markets, international markets, elsewhere, I would have done considerably better. And the same can be said in terms of going into different industries. During that same period, the post-bubble period of 2000, from 2000 to 2008, what you saw was energy did very well, materials, mining, industrials. And that's where I think people should be looking. And people continuing to look to AI and the Magnificent Seven, I think that they're buying bubble valuations, and there's real risk there. Not to say they're not great stocks, and some of them are hot, but a lot will not do well. And I think the odds of you're doing well there, I think, are muted. What we're seeing is the market is spreading out. That's another way for saying the market is rotating to other areas, and you want to buy value. But just to, Mark Heil was, interested in my thoughts on the 60-40 and my argument that today you probably want to be 25% cash, 25% commodities, 25% stocks, 25% bonds. This is not a deeply analytical model, but it makes sense. And here's how to think about it. In 1981, those who don't know, the history of the 60-40 was developed by Harry Markowitz and Bill Sharp, both won Nobel Prizes, the efficient frontier, and they would look to create optimal portfolios. So in 1981, when this really caught fire and everyone was talking about it, you'd say 60%, let's say, into the S&P 500, 40% into 10-year US Treasuries. That's a good balanced portfolio. And I would say yes, and that was very compelling. The PE on the S&P 500 was 8.5%. The dividend yield was 5.4%. And US Treasuries were yielding 15.15%. God, wouldn't I love to be able to invest billions of dollars for a pension back then? Today, it's a totally different scenario. 60-40, you're buying into an S&P that's trading at 29 times earnings with a 1.2% yield. The US Treasury is yielding 4.8%. I don't see much there to get excited about. Kind of lukewarm on Treasuries, but it doesn't even make sense, in my opinion, to extend 10 years. You can get 5 or 6% in the 0 to 2 year range. So bottom line is, I think you want to look for value. I think there are a lot of idiosyncratic high yielding opportunities that I would be looking at. And here are some closed end funds that are yielding in the 11, 12% range. And I think that MLPs make sense, master limited partnerships. They're yielding in the 6 or 7 or 8%. And their distributions to you are a return of capital, so largely tax-free. I was listening to Rick Reeder, who I think is a brilliant guy. He runs the bond portfolio over at BlackRock. He's saying he is seeing 2-year paper at 6.5%. I couldn't figure out what that was. I was poking around, and I'll be doing more work, but that's when you can start getting yields like that, that is real competition for the market. When you don't know what to do, I think that people should be looking at value. And now, for the first time in 40 years, you're seeing real value in the bond market. And I think that people need to diversify. So this is a great looking picture of somebody, and talks a little bit about me.
Hey, Tyson, I just want to ask you a quick question, because one of the things I think's been a little underreported, and we spoke about this the other day, is, because we've been paying off short-term loans or paying off our long-term debt, the United States, with short-term loans. We now have a $7 trillion financing of debt this year. How does that affect your models in terms of where you would buy bonds, or perhaps what you would hold in cash?
That's a very sophisticated question and probably over my pay grade, and I don't spend most of my time looking at the fixed income market. But I think the reality of it is that kind of reflects what some of one of the risks. There are a lot of people who got to do some refinancing, and they're not, interest rates are moving up, and it's starting to pinch some people. But I can't answer your question well.
That's fair enough.
Tyson, I had a couple of questions.
Fire away.
Sure. So you had I'm sorry that you took down your presentation. Can you make it available to the group? Yeah, put it back up, and if you can send it to me so I can distribute to the group, that'd be great. But I had a question about your 25% cash. That seems to be high.
What's that question? I mean, like I said, this is not a deeply analytic thing. This is kind of, I winged it. But what is your question?
That seems like a high number.
The interest rates right now are moving around, and there is that outside possibility we could see an inflationary environment where historically, in 1981, you could get 18% on cash. I think right now, 25%. If there's nothing else compelling, I don't have a problem with it, because you're actually getting paid something, and it's probably more than inflation, which isn't bad. I mean, I would prefer to lock in higher yields for a 2-year period. But the point is, there was a often heard comment that cash is trash. There is no alternative. And the reality of it is, you don't have to be fully invested today, and it really doesn't make it. And if you're fully invested, it shouldn't probably be in large cap tech or the capitalization weighted indices. I think that everybody else probably can talk about alternatives. Ms. Downey can talk about, privates as can Alan Snyder. So I think that there's, there are so many attractive things that aren't popular now that I think that if you're just diversifying, it makes sense. But if lo and behold, there's a problem, there's a hiccup in the market, having 25% cash is going to be something you'll be happy about. But
avoiding
again,
losses.
This is not locked in stone. And obviously that really depends a lot on an individual and what they want to do. But I mean, I think today to go 60% into equities, particularly focused on the capitalization indices, I think you're buying a lot of risk.
So one comment and then a question. So we're seeing a lot of like private tranches going out there and that have ridiculous returns in the healthcare space. And I'm hoping that Maureen talks about some of the kind of private deals she's seeing. I mean, I'm seeing a tranche that's unbelievable right now. I'll discuss it offline with Maureen. But and then I guess the other question is, and really I asked Jeffrey Huge about this. We've got this drill president coming in the office who promised that gasoline prices would be halved within 6 months to a year. Is that going to happen? Your thoughts, Tyson?
Was that to me?
Yes, that's to you, Tyson.
Answer, because I was trying to get back to the page that you wanted me to share.
Elliot, you want to chime in?
My question is, are oil prices going down?
I think oil prices could actually go higher. I think that the economy actually could do well if we get some of these wars solved, and you start taking away some of the productive capacities of Iran and Venezuela, and the economy holds up. I wouldn't be surprised if oil prices do better. Previously, I thought oil prices would drop, but everything I'm reading and heard from people who seem to be pretty astute is our ability really to ramp the amount of energy we want. It's going to take a while. It's not that easy.
Then it leads me to another question, which is that one of the questions on AI is that there's a significant demand for energy from it. A lot of people are like talking about like mini nuke plants and stuff like that, but reality is that it takes on average 10 years to bring a nuke plant live, right? So are people kind of misdiagnosing how to approach AI? Is it better just to be on the grid, or is it worthwhile to build all these large off-grid plants that people are talking about, which take so long to bring up? Any thoughts?
Again, that's kind of out of my wheelhouse or skill set.
Okay, great. Well, no worries. Let's go to the next question.
All right.
So, my next question is mercantilism versus globalism. Your thoughts?
I don't know. You're asking hard questions. You should ask some. Maureen looks really smart. Maureen, what do you think?
Say it again.
Maureen looks very smart. What do you think? Or Elliot? Maureen first.
Sure, I'll take that on. I believe in globalism for sure. And I think that the US has done really well in the last year. Oh, sorry. Thank you for the gentleman in the back to remind me to get on the mic here. I definitely believe in globalism because I think that there's going to be, different parts of the world offer different opportunities. So if you think about like metals or mining and commodities, I look to Latin America. To some extent, I look to Africa, obviously Canada, Australia. I'm not as, I would say, compelled for Europe right now. That's for sure, just given some of the struggles that they've had. But in general, I think you have to look at it not just US focused. I think US focused tends to be safer, but you can definitely get more alpha when you look abroad. I think the key thing is when you think about globalization, though, is that when you're looking at, I would say, developing markets, ex-Europe, say, Japan, US, more developing, those markets, at least on the equity side and even on the debt side, are really concentrated. So you have maybe about 10 companies that dominate those stock markets, and they're really dominated by a couple of sectors, right? Where I think you can get a little bit more diversification, though it comes with different kinds of risks, is if you look at the private sector or going into private assets, but you're locked up for a long time and you need to be in there a long time and you're subject to a lot of currency exchange rates. So that's kind of when I think about investing globally, I think about how would I want to basically construct my portfolio. How much of it is public versus how much is private. I've done well in the past investing in private markets overseas, but I've also taken some big losses, especially when I did some secondaries, because I didn't have the time to recover because I took a big bath on the foreign currency. So that's kind of how I think about it. I don't think there's necessarily more risks. Sometimes when you're investing globally, there's just different types of risks. There's the foreign exchange.
I guess my point of view is that half of the largest global companies in the world are American. So they may be impacted negatively by tariffs.
Yes. And that's a very complicated question because before I became an alternative investor, I was a banker for my sins for many years. And I worked over in London with Goldman. And I used to spend a lot of time on helping big multinationals figure out how they could bring their profits. I remember they had the Patriot Act, I think, at some point in time, right? And it was really about how to bring profits back to the US in a tax efficient manner. So it's a good point that you bring up. I think it's more complicated because yes, I do think they will be impacted by the tariffs. I think taxes will play into that as well if they decide how they want to do their CapEx. And at least my sense is that there's been a lot of talk about the tariffs, and not that I know Mr. Trump personally by any means, but sometimes I think that there's a lot of talk, and then when we actually get to what's going to transpire, it'll be something more mild. At least that's my hope, because I don't think having lots of tariffs bodes well for trade and actually for investing. But that's my perspective.
Yeah, and I actually wanted to direct the question to Elliot here because I pick it up on what Marty said a little bit, and he sent me an article last night. So, Marty, I'm referencing your article here that pointed out the 50 largest stocks in the market. They combine, and this goes to the overvaluation of the market. Back in 1989, it would be 53% of our GDP, and today it's currently at 230%. These 50 stocks are now valued at 110% of GDP. For context, that's higher than they were in 2021 and over 400% higher through the trough of the 2009 financial crisis. So, Elliot, my question to you, and I'm very curious about this because you've had this marvelous track record for 10 years, is how does global real estate asset management generate a Sharpe ratio that's exceeding every U.S. major market index?
Yeah. So real quickly, I'll answer that question, but I do want to answer the question. I do want to comment on the tariffs. As cool as I might be, I actually did read, or as I might look, I did read the entire tariff document that was released when Trump was president last time. And because that's what an exciting Friday night looks like for me. And a lot of the stuff on there, it was extremely specific, and it was stuff like a spring that you would find in a grill, or a bolt that only went in the wheels of trash cans. These were very non-specific. There were some that had broader impact on the economy, but by and large, that 600-page document was not. And I think we saw in the stock market, if I recall correctly, the stock market initially responded, but certainly went much higher. So while there's threat of tariff now, historically, the tariffs that were put in place were not material to to the economy and certainly didn't have an impact on the overall stock market. I also think it's worth noting that President Trump is highly focused on his perceived performance, and that would probably be tied to the stock market valuations. If there was something that President Trump could point to as his success, it would be unemployment, stuff like that. So I'm candidly, I agree with the sentiment around valuations. I agree with the sentiment around uncertainty, but as it relates to global return, we respond to prices and not necessarily headline news or macro trends. And that's a great segue into your question about achieving our Sharpe ratio. We're really focused on risk management. And there are two ways that I categorize risk into two categories. The first is the planning category, the planning phase. And that's where we plan for the risks that we know about and plan for the risks that we don't know about. But the Mike Tyson adage applies, which is everybody has a plan until they get hit in the face. And so that's when the second aspect of our risk management really comes into play, and that's detect and respond. And being able to do that in real time is how we've been able to minimize losses and increase our returns.
I want to comment on that Sharpe ratio. I think that is really a inappropriate statistic to evaluate real estate, because what you're doing is you're dividing by the volatility, and you're comparing liquid daily markets that trade massive amounts every second, and you get real-time valuations, to office buildings that trade every decade. And
so we don't,
let
me real quickly, Tyson. So I know Mark referenced the word real estate. So we don't, in Global Return's name, we don't invest in hard assets or real estate. We're strictly public liquid markets.
And my point would be, I would be leery of using that Sharpe ratio as a compelling reason to buy real estate. Real estate has a lot of the interest rate sensitivity that has been wind to its back for 4 decades. And while there's always going to be attractive real estate investments, I don't think that, like bonds and like the S&P 500, they're easy money anymore.
Yeah. So again, our Sharpe ratio has nothing to do with real estate or hard assets, and I don't encourage.
It was Marty's question, so I'm trying to answer Marty's question, not so much with regard to you, Elliot.
Well, I want to also go back over to Alan right now, and Alan, been hearing a lot about the public markets being oversold, but a lot of people have the same opinion about or being overvalued, right? Have the same opinion of the private markets, particularly venture capital and private equities. So I wanted to get your thoughts on that, and also see if you agree with that, and then where you think people can find alpha in that. Maybe that'd be the time to also throw up your aShareX presentation and walk people through how you help them find that.
Okay. Share screen. A couple things. Number one, not to be a negative Nelly, but the one thing that we all are seeing in the market today is this enormous flow of capital into specialized debt instruments. Having been a lender for years and years and years, I would caution people to be very careful today about the huge influx of money into specialized debt. Why? You don't really know how performance is going to shape up, because the early days of debt investing, you've done due diligence on wherever you're investing in. And so you have about a 3-year period where that due diligence is impactful. But after that period of time, you start to see problems emerge for some money managers, not all. So I would caution people, given the huge flood of money into specialized debt, the relaxation of some of the credit standards, to be very careful about that. And then based on Jeffrey Hughes, his comments this morning, the stock that normally I don't talk about individual stocks, but an interesting one that builds on some of the commentary so far is Schlumberger, which has an handsome dividend. It's declined. But given the sentiment that Tyson talked about and everybody else, it's an interesting, some of the high dividend conservative stocks are an interesting place to be. So that's what I would say on both. And
Perfect.
now, can everybody see the?
We cannot.
You cannot. Okay, let me.
Marty, does he have sharing rates? Do you know how to
I'll
turn
speak-
on your sharing?
All speakers have sharing rights.
Okay, so go down this. If you click with your mouse on the bottom, you'll
Okay.
see share, and just click on that up arrow.
All right.
There you go. Now we can see.
All right. Now you can see. Great.
Well, we need. There you go. Now we can see your presentation. Excellent.
Okay. Let me rocket through some slides and fasten your seatbelts. aShareX is an asset share exchange. It's not a money manager, and you'll see more about that in a minute. Fast Company, which looked hard at us, said we're one of the next 4 things in fintech and crypto. I'll let you be the judge. Here we go. Basically, aShareX is the first and only fractional auction platform. For the first time, fractional bidders can bid on any asset. Think of a $50 million apartment building, $30 million Picasso, and compete with each other and compete with 100% bidders all in the same auction system. Pretty nifty. Now, how is this disruptive? Is this a breakthrough? For the first time, you're really democratizing ownership. Maureen's talked about that, of otherwise unattainable assets. How many people can buy a $30 million Picasso in its entirety? Damned few. How many people can buy an entire apartment building? And I'll talk about why this structure is better than some of the other ones out there. You're basically attracting a huge new buyer cohort. Think about it. Versus a money manager saying, hey, Ellen, this asset is worth $30, $50 million, whatever it is. You're using an auction to get true price discovery. Wow.
Can I ask a question, Alan?
Sure.
Alan, quick question.
Yeah.
Yeah, just quick question, Alan. Just for a little bit of background, I spent some time working in the digital asset space too, and put together an RA for it. So I was kind of curious, I'm assuming this is not token based. Is that correct? You're not tokenizing.
It's interesting. It's a great question. We looked, when I originally thought of this idea, I said, oh boy, blockchain, tokenization, rub it all over your body. It's the hot new thing, the bright, shiny object. Great, except the SEC does not recognize the immutable record of blockchain in general. Now that may change. So we architected the tech stack that we've built so that we can throw a switch and use blockchain and tokens. The ERC20 token, for those of you that are into it, has been hacked, so you got to be careful. So at the moment, fractional owners, if they were to win the auction, get an SEC qualified Reg A common stock. Now, every lawyer I know said, Snyder, you'll never get through the SEC. Well, we confounded them. We did, and we've conducted several auctions and issued the securities. One other thing that's very different from what we're doing. How often, I can't see a show of hands, we've all invested in some deal, and the money manager says, Alan, you're too dumb to know when to sell this asset, so we're going to charge you 1.5% to 2% a year until we decide to sell the asset. always rankled me just a tad, said, wait a minute, I put up the money. Why don't I get to vote? In our case, the investors, based on a simple majority of the shareholders, can vote to sell the underlying asset. And by the way, there are no annual fees. We architected this, being the young sprout that I am, with full regulatory compliance with the SEC and FINRA. Okay. Bold assertion, disruptive, game-changing innovation. This execution can solve problems in trillion-dollar markets. More in a minute. This is the full enchilada. We integrated to 14 different service providers, including a broker-dealer for the primary share issuance, a broker-dealer for any secondary trading. The full payment rails, all of that jazz is in place. It is a full-on trading system, market orders, limit orders, all of that jazz. And interestingly enough, if anybody finds this compelling, you can actually test drive the auction on our website, aShareX.com. It's scalable. We can handle up to 5,000 concurrent bidders. In the auctions we've conducted, we processed more bids in 4 minutes than any auction house has ever done, I've been told. Being a nervous Nelly, as I've said, we have 4 patents pending, 250 pages of light reading to build a moat around what we've created. If somebody were able to circumnavigate those patents, great. It's going to take you a bunch of time and a lot of money to replicate it. Okay. Let's see here. There we go. Trillion-dollar markets, bold place. We will execute in the collectible space. It's about a $2 trillion addressable market. Think my $30 million Picasso. Think jewels and gems. We're probably going to auction off a yellow diamond. By the way, appreciation in yellow diamonds and colored gems has been terrific in the last 3 years. Collectible cars, you always wanted to own that exotic Ferrari. Sports memorabilia, very, very active market. A Babe Ruth jersey just sold for $24 million, if you can imagine it. Comic books, same kind of thing. Now, we will not execute directly other than empowering other people through SaaS partnerships in the capital markets. I'm going to get to real estate in a minute. That's just one example. Think royalties, think some of the other stuff that this would apply for. All right. How many people, again, I wish I could see a show of hands, have invested in a Reg D? Most real estate deals are done in Reg Ds, certainly the private deals. Let's compare aShareX to a Reg D real estate deal. Okay, assets pricing is determined by the money manager. The money manager says, okay, this apartment building's worth 50 million bucks. aShareX says, baloney, auction it off and have a market price. Regulatory oversight on a Reg D, modest at best. aShareX got to file an offering circular and having it be reviewed by the SEC. Investor qualification, whether it's a 3C1 or a 3C7 in a Reg D, is high. Reg A, thank you, Jobs Act, is very modest. Investor counts, whether it's 3C1, 3C7, 99 to 1999, Reg A, unlimited. Offering size, unlimited with a Reg D. We can do with the auction system either a Reg A or a Reg D, so highly flexible. Liquidity in a Reg D. How many of us have experienced this? Low, maybe very little. With aShareX, you've got control of the asset, so you can say sell the bloody thing, or if the asset is big enough, you'll have a secondary market. So investor control is high, and Reg D, the cost sometimes would make a private equity player blush. Okay. So for a sponsor, think of you out there that are sponsors, you now have the opportunity to get more buyers, higher sales prices because you've got this huge new cohort to attract, and investor satisfaction. And auctions are exciting. Okay, for the investor, I went through most of those benefits. They're substantial. Now, okay, what are we looking for? We've built it. The technology works. It's scalable. It's no longer an idea that I've talked about in the past. It's there in place, diligenceable. Now we're looking to raise an additional $5 million in chunks to scale the business, increase the marketing, increase the selling, and some very, very exciting opportunities we're in pursuit of at the moment. That's a thumbnail on aShareX. I think of the many different companies I've started, I think it has some of the most potential of anything I've ever done. So let me pause there and see if there are any questions, complaints, or suggestions.
No, I thought it was
Yes,
very
yeah.
exciting. Go on, Maureen.
So I'll say I'm pretty familiar with these models, Alan. And so my question to you would be, are you trying to be basically a market maker? Is that essentially what you're trying to do with aShareX, is be a market maker?
Basically, what we are doing, you think about it, it's an asset light model because we are an exchange. So are we a market maker? Really, we're giving a new opportunity to attract investors into a market that has not been available to them. Are we a market maker? I don't think of it in the terms of being a market maker. We're in the terms of the facilitator to allow it. Maybe with a secondary market, will we be the market maker? No, I think others will be the players that will provide liquidity in the marketplace. Now, to have a secondary market, Maureen, as you know, you're going to have asset sizes that are fairly substantial so you can have trading. Now, you're starting to see that emerge. All of this is brand new, and you're starting to see it through people like North Capital, et cetera.
Hey, Alan, if you could lean in just a little bit when you speak, because your voice was much better a minute ago, but you got very faint at the end.
I actually have a couple of questions. So, so Mike, is this an ATS, Alan?
No, it's an ATF. No, it's an
ATS, an alternative trading system.
Kind of, sort of. It's basically creating a structure to attract a huge new wave of potential buyers into alternative assets with a structure that's better than most of the others that are out there. That's what it is. So we will be sourcing, in one sense, you think of an exchange. What do you need in an exchange? You need bidders or buyers, okay, coupled with stuff to sell. Shades of when I built the insurance exchange. We needed product from insurance companies and then we needed people to buy it. So we're marrying those two together is really what we're doing.
One of the things that I've seen as a challenge is that you can pretty much with technology now replicate many things that have been done manually. But the issue that I've seen in the past is, does everybody want that kind of transparency? Like there's obviously LPs that would want this transparency, but not necessarily sometimes the sponsors, especially in the secondary market. There's a desire for lack of transparency because they use the secondary market to their advantage. Two, you have to make sure that information flows relatively freely. So one of my questions was also going to be, are you going to digitize the information, about the assets that would come onto the platform to make sure that everyone has access to the same type of information, right? And that in the past, I've seen come up against problems with confidentiality. So those would be, I guess, two of the things that I would probably raise is that, one, of the asset owners, does everyone really truly want the transparency? Two, can you digitize it in such a way that there is a dispersion of adequate information out there? And then three, depending on who you have come to the platform, who's going to set the price, right? Are you going to have a lead price maker? When you talk about big substantial assets, many times I've seen in the past, because I was part of a couple exchange platforms, big owners or big holders of assets don't want a lot of information out there because they don't want to move the market. I can think of some instances around Palantir trades that I saw in the past. So just how would you respond to that, Alan, and your thoughts?
Again, very thoughtful. Let's compare what we're doing with the major auction houses, there are major auction houses now for real estate. There are TrueMid, Crexy, others. We can compare it to that. We can compare it to Christie's, Sotheby's, Bonhams, Phillips, etc.
Alan, can you speak?
It's on his side.
Right.
People are just raising their hands just to have you speak a little bit more clear. Thanks.
You
or
can
louder.
compare what we're doing to let's use Christie's as a foil. Christie's auctions off high-end art, high-end collectibles. Okay. And Christie's provides information to the bidders. They deal with 100% bidders. Now, for the first time, we are bringing a huge cohort of potential bidders. Now, if I'm a consignor of an asset, a seller of an asset, a sponsor, what would I like? I'd rather have more bidders in any auction than fewer. Why? Because as the seller of the asset, I would hope that those additional bidders will drive the price higher, because I'm not going to rely 100% on somebody that can buy the entire, in this case, let's say a Picasso. The information that auction houses provide is pretty significant. Their evaluation, their high lows, and the history of the asset. We do the same and have done that in the auctions we've done. So basically, you have this tension in any marketplace between the seller of the asset and the buyer. Think again, Christie's. Christie's wants more potential buyers. The consignor would like to have more buyers. And we're bringing the ability, taking any auction house, and we've partnered with some. Most auctions, 90% of all auctions are for items $50,000 or less. Okay, that means there's a huge potential audience of people that play in those auctions and can't afford to buy more durable assets, more values that will be good over time because they're too expensive. We're enabling that group to be participants. And you're right. A private equity firm frequently likes to have the lack of a secondary market. However, disruptive technology has the opportunity to disrupt stuff. So you're starting to see that. Take real estate. TrueMid, Crexy, players like that are beginning to auction off apartment buildings, office buildings, etc. And we can enhance their offering substantially. So that's what I would say and answer your question, Maureen, which are good questions. Having been on the bleeding edge with the insurance exchange, same kind of issues were true there. Did an insurance company want price competition? No. But eventually they had no choice because we were there. And so we would give people the ability to compare 15 or 20 different prices on their auto or homeowners insurance. And then the carriers pretty much gave in and flocked to what we were doing. Same here, it's early, yes, but the benefits, as you noted, the benefits to the investor are substantial. That can be a driver.
Okay, yeah, I think that's terrific. I think we see the benefit of aShareX and all that it provides, and certainly encourage everybody who has an interest in this to pick up with Alan. And Alan, be sure to type your contact information into the chat so that people know how to reach you. And I would encourage all our panelists to do that. Maureen, I want to come back to you to the question I had Alan answer initially, which was, do you see the private markets having some of the same problems as the public markets with overvalued assets? And if so, where are you finding the alpha? And Alan, if you could discontinue your share, that would be helpful. Just click on that button again.
Yep.
Thank you.
Here you go.
Yeah, I think the private markets are kind of still adjusting, but it depends on what part of the private markets you're talking about. I think people that are in the venture world, a lot of them thought that there was a recalibration of valuation, certainly in 22, but even into 23 and 24. I still think it's happening. I still think a lot of companies are overvalued. A lot of times when I take a look at portfolios where someone would like to sell either a fund or a collection of assets, the first thing I do is I go to when was the last time they did a round, and if they did it in 21, I know that it's a big, adjustment that's going to happen. And they're like, well, it's going to go here, and I'm like, fine, let's talk about an earnout, and we'll do it on that basis, right? So I definitely think that there's a lot of valuation adjustments that are coming. But not just in venture and growth. I think very cautiously when I take a look at buyout portfolios and I take a look at when was the last time the debt was put in place. Do you have a refinancing risk in the next 6 months, 12, 18 months? If you have to refinance something, how much higher is that interest rate going to be? There continue to be many what we call continuation funds or GP restructurings. It's basically a way to get another life out of a set of assets, more fees, more carries. So in terms of alpha, where I've saw people being creative, and I know that earlier, Tyson had mentioned all the structured debt that's out there. I think there are some good applications of opportunistic or structured debt, especially when it comes to the growth space, rather than following with another equity investment to do a more structured investment into a company. And so that's where I've seen some creative, more opportunistic funds. However, I've also seen a lot of credit players try to get into this venture segment of the market without knowing a lot about venture. So I think as you're looking at managers, just be aware that I think from a credit perspective, it tends to be glass half empty. And from venture, it always tends to be more glass half full. And finding those managers that have the skill on both the credit side, as well as truly being able to understand not just how to value a venture company, but having a network within the venture company, because it's very relationship driven. It's a different sphere within the alternative asset space, I think is important. I do think that on the secondary side, about 80% of all the volume is handled by about 16 funds right now. So I think there's been a lot of pressure on the secondary side. And so if that is something that you're considering to go into a big secondary fund, I think what's really key is to look at how much leverage do they have on their underlying fund and how much leverage they put on the underlying deals, because that doesn't necessarily tell you the truth when you're looking at their returns. Some of those returns can be pretty juiced by leverage, and that's a different risk profile. And that's one thing I see a lot of LPs don't take into account. I'll pause there.
So a question about, I have a question about the secondary funds. What we found out from talking to the largest secondary funds out there was that more than half of the investment from secondary funds is into continuation funds, right? And I'm not sure the continuation fund profile is anywhere close to what secondaries were like, let's say in 2009 and 2010. I mean, you've been around a long time, and secondaries were outstanding
Yeah.
back in 2009 to 2010,
There's a reason for that.
right? But now with these massive funds, I'm not sure that opportunity is the same.
No, it's not. I mean, you're looking at just a massive amount of capital that's gone into the secondary space, especially in the last couple of years. And so you have basically a huge pressure on deployment, right? Just like with any GP, nobody wants to give money to a GP and then have them take fees and not deploy it. And so you've got a pressure to deploy. There is a fair amount of flow. In my experience, only about a third of, say, secondary deal flow gets transacted on. In the last few years, over half of it has been in these GP continuation funds. Many of these GPs probably shouldn't exist, but because of lack of opportunity, I think that there's been creation of these deals. You've seen also a lot of continuation funds that have only 1 or 2 assets, so it's really a lot of concentration. I think it's also why you've seen this rise of, I'll call it like venture secondaries. Like from my perspective, I started doing secondaries back in 2007, and I watched, although I wasn't at the time doing it, but I watched saw a lot of the results of funds that did secondaries in venture after the .com, and very few of them actually had good results. In fact, just because it's on sale doesn't mean you should buy it. And it's kind of been one of those things where only 10% of the venture managers deliver good returns, right? And so where you made money in the past doing ventures, you bought at a really significant discount. The issue I think now is that so much money in the last 10 years between 2010 to 2021 went into venture because of the, I'll call it perceived reduced risk premium, because you just were looking for yield. You had the venture market grow by 3x. You had a lot of non-traditional private investors come in like in mass. And then you had the sovereign wealth funds come in, i.e. the likes of SoftBank. So you just have a lot of money that's been put into this venture category now. And these companies are still looking for liquidity to be able to grow. And then I think that's where you're coming up with some of these more interesting structures for debt or ways to get funding. And then you still have folks that are looking to get liquidity out because they'd like to invest in other asset classes. So I'm not sure if that answered the question there, but.
Well, I mean, actually, you brought something up. You know, one of the things that everybody asks about a fund when it goes to market is what's the capacity? And the question is venture capital outgrown its capacity? And before you answer that, you know, Bob Bozeman, who was one of the first partners in SV Angel, which is a legendary investment fund out of Silicon Valley, he said, you know, the reason why venture capital started was in California is because nobody in Boston wanted to sell shares of their companies, but Californians are much more, you know, interested in being able to do that. There's only so many, you know, great companies. So looking at venture capital, there's more than 1,300 unicorns out there that haven't gone public. Only 45 companies went public that were venture backed last year. So that's a pretty long wait for that to clear out. And assuming, you know, no other unicorns are printed, but there'll be more unicorns printed than ever because it's easier to get to $1 billion valuation than ever. So what are your thoughts on that?
Well, venture capital, it's an industry, right? I mean, there's a lot of people that are employed by it. There's a lot of funds. Once you build a firm, you have to keep raising a certain type of size fund in order to keep your infrastructure going. So I think there's going to be that pressure to keep raising capital. I think the LPs that are invested, there is a bit of, I would say, a juggernaut there because they can only invest if they get distributions back. And that's been a lot of the complaint in the last couple of years, is that we're not getting distributions back to put more money into your next fund. But that comes to the point that I made earlier too, which is why the high net worth and the ultra high net worth markets have become more attractive to not only the big private equity funds, but also some of the, I'll say, even growth managers looking for more capital. But
so there's a difference between looking for capital and actually getting returns.
Yeah, I think there's still this desire for capital without actually showing the returns. one of the key things is, one of the key things that you have to really look at.
Just think about that, guys.
Yeah, but one of the key things that you look at when I think you're looking at it from an allocator perspective is there's a lot of like high marks. Like I've definitely seen funds that come in and they really haven't had much DPI in 10 years, but they're still marked at a really big TVPI, the total value to paid in capital. But I'm like, but your DPI is 0.2, right? And so I think that's the key thing that you really need to look at when you're looking at some of these managers is what have you actually returned back to your investors? So that is also what puts the pressure on for these continuation funds is not.
Right, so I guess a lot of people say MOIC.
MOIC, yeah.
Right.
MOIC, it's the multiple on invested capital.
But it's not real returns to investors.
Well, DPI is, which is distributions to paid in capital.
That's the distributions,
That's
right?
the
It's different.
DPI. That's what I mentioned. Sorry, I should have clarified that. So some of the continuation funds or the selling of a strip is so that they can actually generate some distributions to turn back and give to their LPs. So their LPs are more ready to say, okay, we'll re-up and put some more money into your next fund. So that I think is one of the drivers as well. I mean, one is, hey, the asset hasn't grown where we wanted it to be. And so we want another 5 years to see if we can grow it and get a bigger return on it. And then the second part is that, well, we might do a bit of an increased funding for some of these assets, but we also might want to do a bit of a secondary trade, give some money back to existing LPs so that at least they'll be able to justify putting money into our next fund.
So, I mean, the way I look at the world is that, so there's a certain number of people who come out of, get MBAs in finance, they work at the banks, et cetera. They end up trying to start hedge funds or they work at private equity firms, they try to start their own private equity firms. Y Combinator alumni try to start venture capital firms. I mean, there's like this ratio of just production of these firms and whether they're needed or not, right? And so, so my question, because I'm really thinking about it from a family office point of view, which is just an aside, Mark Cuban said that he's not, he's broken even, maybe worse than that on his Shark Tank investments, right? But Kevin O'Leary has done great. And just actually from a reputational point of view, I mean, his reputation is amazing, right? So should people be looking at alternatives to venture, such as revenue financing or royalty financing or, things along those lines? I mean, I think that, so Kevin O'Leary's great deal was Wicked Good Cupcakes, where he got $1 per cupcake until he got his money back, and then he got 50 cents for every cupcake sold into the future. I mean, any thoughts on that?
Yeah, I mean, I'm a big fan, I think, with private equity, just because you're in it for such a long time, is to really give a lot of thought to alignment. I mean, that's really, especially when you're coming in as an LP, you don't really have a lot of control. And so think a lot about how can you best align yourself with that GP, whether it's a GP or whether it's a private company. And so if there's a revenue share agreement that you can put in place, I've seen that done, and that can be, that can be actually really good too, especially if you don't want to actually sell the company eventually. And there's a way, for instance, for you to get your capital back with then some return, but then the company is remains private. I've seen this a lot in the B Corp and in the social impact space, where they don't necessarily want to sell the company, but they want to grow and scale it. But the people that put the money in want to get some return back. So I think alignment, and I think that sometimes just not necessarily putting equity in, but some type of structured arrangement, like a revenue share, some type of earnout, where it's specified that if certain hurdles are met, the person who put the capital in will get a certain amount of capital back. And if they want to exit at a certain date later, that they get, 3x, 4x, whatever that specified.
Maybe some warrant coverage.
Yeah.
Yeah, and I'll just piggyback off that for a second, Marty, because I think I deal with royalty finance companies all the time in terms of what they're looking for. They're much more, when you talk about early stage, seed stage, they're really not operating at that unless they're generating some decent revenues, because they want to be sure they're going to get paid back. So they're happy to, they usually take a small percentage of the revenue as it comes in until they get to, again, as Kevin O'Leary, until he gets to all his money back. And then there's a certain time period thereafter that it continues, so they make some profit. So that's the real metric. And the usual complaint that you hear from them, if you deal with them multiple times, is how long your last company took them to reach that point.
Right, payback period matters, right?
Yeah, absolutely to them.
So 3 other questions for you, and I think they're going to be rapid fire. They're really easy. Search funds, pledge funds, and independent sponsors. Your thoughts?
So when you say independent sponsors, I think fundless sponsors. Is that what you're talking?
Same thing. Yeah,
Yeah,
I mean, it's
same
a
thing.
nicer word.
Fundless sponsor, that's a lot of ways which new funds get basically created. I mean, in fact, if I were talking to a GP, I would say, look, your best bet is to go to family offices, bring to them some attractive deals, pitch them to say that they'll get co-investment, for no fees, no carry, but a percentage of that deal will go into your next fund, right? The issue with fundless sponsors is that you are putting them in business. So you have to make sure that they have some skin in the game. And in the past, when I've done transactions where I'll call it a management buy-in versus a buy-out, when they buy in, you want to make sure that they have some skin in the game. That's the alignment. And it doesn't need to be commensurate with yours, but I think it just needs to be a relevant part of their net worth to make sure that you have that alignment with them.
Well, I mean, historically, it's been like a 5% to 10% of the committed capital. I don't know if that's still the case.
It really matters. I mean, in the past, what I have done is to say, okay, what's your net worth? And sometimes the people in the partnership have significantly more net worth than another person does, but it just has to be meaningful to that party so that you feel that they're going to be as committed, because 5% of someone's net worth may be, may not be that much, right? 5% of a deal. So I think that's the more key thing, is the relevancy.
I think the value of the search of the search fund or an independent sponsor or independent sponsors, that they build the value, right?
Yeah.
Right. I mean, there's a lot of private equity firms of capital out there, right? And they don't really spend time developing relationships.
Yeah, I mean, you can really, I think it's a great way to get to know a firm. The issue is sometimes not all GPs have the luxury of, basically fronting a whole team for like a year or two, which brings you to the firms that do the GP stakes, right? And so there's different ways to do GP stakes. And for those of you guys that don't know GP stakes, there are firms out there that will help new managers get launched by giving them anywhere from 10, 20, $30 million, depending on the amount of capital they're trying to raise, for a percentage of the economics, not only in the fund, but in the GP itself. And then over time, they can either structure where they're going to reduce their ownership of the GP. This is something that tends to be better if you're an LP that comes into fund 2 or 3, you want that. But I think there are more of those now. I've seen, of the firms that I know that do it, I think they've been more successful doing it with private equity funds than I've seen them do it with hedge funds. But I've definitely seen not only private equity funds, but hedge funds being staked.
First loss capital, thoughts?
Not necessarily, not always. Usually it's, they'll take a percentage of the economics. Sometimes it's first loss. Sometimes they make a loan. And for instance, the loan gets repaid. And then there's a way for them to get out at a multiple.
Maybe Mark Heil has some comments on first loss capital, because I mean, the first loss capital companies came to us more than 10 years ago. They had like, $50 million under management or 20 million. And now they're like all multi-billion-dollar companies, because originally people thought they were going to be into the seeding business, but actually a lot of mid-tier hedge funds came to them. Any thoughts, Mark? Or
well, actually, I saw Elliot smiling there, so I don't know if he had a particular. Elliot, you're muted, so if you want to chime in.
Yeah, I have some opinions here. So it's a great business model if you're the first loss capital. I'm sorry, if you're the
Staker.
If you're the fund, the staker,
if you're the fund, they reach out to me pretty frequently, and my response, respectful, is I try to make it sound respectful, but the fact is, if I want to use leverage, I'll keep 100% of the money myself, because that's what it is. It's leverage on my fund, and I have to share that with somebody. And I think over time, emerging managers will wake up to that fact, that it's actually just my leverage, that I then have to share profits with somebody. There are 2 funds I've spoken with that are actually providing capital now. They started off as first loss and now they're providing capital, and I might work with one of them. But I think over time, the other thing too, just from an operating and risk management standpoint, we've talked a lot about how most valuations are high right now. It's very easy to grow when there are a lot of emerging managers who say, oh my God, they're going to give me $50 million and I'm trying to grow. And that emerging manager may not conceptualize that, well, I'm actually just sharing my profit with somebody else at a levered basis. And so it's very easy for these funds to grow. And I applaud anybody who got into them on an early basis, because it is in many ways a risk-free return. However, with that growth comes hundreds of managers, comes market shocks, comes maybe not the best compliance. The incentives for the first loss companies is really just to get as many warm bodies as possible. And I'm not saying that they have poor due diligence. I'm not saying that they do a lousy job of evaluating their managers, but their incentive really is just more. And it's more because they don't a significant majority of the time, they don't actually have their capital on the table. And I think that opens up the industry for systemic risk in the individual businesses.
I totally agree. And that's part of what they provide too. They provide the compliance. They provide the, finding the additional investors to come in and help grow the fund manager.
Okay.
That is that's part of what they offer, but that's how they help manage it. And they also provide a lot of times the back office, right?
Really? Okay.
So I haven't
talked to those. Those are higher quality firms than I've talked to.
I think you're thinking about boiler rooms, right? So I just had I just want to make a remark, and maybe Maureen can comment on that. So there's been an explosion in search fund of funds. I went from like 2 to 6, and so search funds say that their average return is around 37% IRR. Sounds highly investable, but maybe, so a search fund is typically you get a guy who's just out of Wharton or Stanford or Harvard looking to acquire a business that they can take over and turn around. I mean, that's the easiest way to describe it, right? And somebody stakes them, right? So it's almost like a SPAC. Yeah, it's a private SPAC, right? Any thoughts on that? Because it's an interesting business. It's been around for a long time. I've seen a lot of guys do really well in it, but it just never gets it's never a headliner. And I'll tell you, so there's a guy named Mark Sinatra. He's a Wharton guy. He came to me like right out of Wharton in 2008. I got a search on blah, blah. He bought a great company in Dallas from the guy who was looking to retire, turned it around, grew it, sold it to the Asian counterpart. Before he knew it, he was running the whole Asian business himself. So they said, well, we're gonna bring 1,000 people to the U.S. to help you run this business. It went from like 100 employees to 1,000. He's running the whole North American division, and now he started a fund of search funds, and he's like one of the guys who's in it. And there's a guy here in Silicon Valley who also has a pretty significant search fund of funds. But they're always under the radar. Staking is typically $10 to $50 million. Any thoughts?
No, I've seen that. Go on.
Good, Mark.
No, I was just going to say, it's an interesting model, and I think it's preferable to the independent sponsor for anybody that owns an asset and is looking to raise capital, because they have the money behind them. They have committed capital. And I think that makes them, right now I'm working with a food processing company, and, people have said to me, well, maybe you should go to independent sponsors or search funds. And I said, well, I'm willing to deal with search funds because they have committed capital, but independent sponsors are going to ask me for 60 days to go out and raise the capital. You're not buying me anything there. It's actually putting me in a worse position. So
it's interesting. Yeah, it's an interesting comment.
Well, that's the whole issue with, I think, fundless sponsor is you're precarious, right? Because you spotted a deal and then you have to go shop it to people that could actually intercede and take your deal from you, right? Because usually in the past where I saw this would come with a portfolio of orphaned assets or assets, and then they'd shop it to the entire secondary market to try to get capital from either one or a consortium, right? And there's always the risk that you lose the deal to somebody else, right? Whereas I think, as Mark pointed out, if you are a search fund and you have committed capital, one is that you're going to get the attention of the seller, much more focused, because they know that there's more surety that you're going to be able to get the investment. I guess the thing on the search fund is I kind of go always back to the alignment. What is the nature of the relationship between the search fund, the person who's actually acting as the buyer of the business, and how they're going to grow it, right? I mean, it could potentially work out, but one of the things that I've always been cautious with GPs that have either been launched, inside of corporates or inside of banks, is that if they do well, they eventually want all the economics, kind of like Elliot was saying to himself. And even if maybe the founder of the fund still stays captive, where they're giving away 25 to 50% of their economics, their engine room, their principals will spin out and leave because there's not enough economics for them to share. And they know that in the market, if they go out and they have enough experience, that they can take the risk and raise their own fund. So that's kind of how I look at it, Marty, when I'm thinking about search funds. I'm like, where are the economics ultimately going to fall? And if someone's really successful, do they stay? And are the people that are most successful, are they really the ones that are generating the return? And if they don't stay, then maybe it's not so attractive to me.
And then my final parting comment is, so we're here at JP Morgan. It's and actually it's an outstanding JP Morgan. It's probably as good as it was pre-COVID for those people who were here pre-COVID, right? But there's been a lot of bad deals that have come out, I think that somebody said there was like 14, and Norm Frieden will talk about this, 1,400 companies raised more than $10 million before, by 2021, and 700 of them gone under in the last 2 or 3 years. In your estimation as a private investor, was it better? Because a lot of them came to market trying to save themselves with bridge rounds rather than down rounds.
Mm-hmm.
We had somebody come and speak and talk in Florida and talked about how, he had a down round where, 95% was wiped out of what people had invested, but they were allowed to invest in the next round. He said he saved the company, right? And his worldview was, I raised $80 million, and then I raised this other round of 30 million at a much lower price. People were crammed down, but the company was saved, and there's an opportunity to make money. Any thoughts on that? Because there's been a blowout in healthcare.
Sure.
Things seem to be coming back from the ashes. Any thoughts?
Well, I guess when you raised that question about this other individual who talked about it, the way I interpreted it is that he took on equity that didn't have necessarily debt-like terms, right? And so if you take on a bridge,
he was a broker. He didn't do a bridge. He did an equity round. Yep.
Yeah. And so when I think of bridge, I think of ever increasing financing costs. And then if you don't get the takeout, then it becomes very punitive. And so therefore you run out, you have liquidity issues, right? And so I think people are always really optimistic about how prospects are going to go, but you should probably budget for things not going as well and give yourself a lot more runway. And it's better to stay in business than I think to gamble on a really punitive high interest rate. I mean, I started my career in structured finance and high yield. So I did the credit thing at the beginning of my career, and then I've now kind of on the other side, on the venture side. So I'm always, if you can, to get a more, especially when you don't have as much visibility in terms of how things are going to play out. And I also used to cover healthcare companies when I was a banker. So the other thing I know about healthcare companies is that you can't always play the regulatory game, and you don't know what's going to happen, and you don't know how you're going to finance your clinical trials. So it's a big market. I mean, there's many different types of healthcare companies, but I guess first and foremost, in this market, making sure that your capital structure is as flexible as possible so that you don't have a punitive interest rate that's going to run you into liquidity issues, I think is key. And then giving yourself as much flexibility in the healthcare space, because you have this regulatory dynamic, depending on what you're doing, like drug discovery, that you don't necessarily have in other markets. And that's something that you don't always control. And that can really derail it. It's very binary sometimes. Does that answer your question, Marty?
Yeah, I mean, I think that the answer is better to survive another day than to, because the reality is the market did exactly what you said. It puked all over these bad deals. Nobody wanted to do a bridge round.
Well, and I think the other thing too is you got to remember, a lot of people that do healthcare, at least from my perspective, are extremely passionate. They're trying to save the world, change the world. It's a little bit of a different motivation, I think, sometimes than maybe in other sectors. But if you wipe out your entire cap stack, that means you may wipe out your own equity as a founder and many of your team. And so then the question is, gosh, who am I working for? So there's that alignment issue too that you have to think about. So, I mean, there have been a lot of companies. I will say one other thing though, too. I went to a AI AGM and I thought this was really interesting. There was a gentleman who had a company, and his company basically was helping healthcare companies design their clinical trials. And normally it takes about at least 6 months for a drug discovery company to put together their clinical trial program. And he said, most people don't know this, but the clinical trial approval process for drugs just keeps dropping. And he's like, right now, only 6% of drugs that go into clinical trial are actually approved. And he says, we think it's going to go down to 4% and it'll plateau there. And I was like, oh my gosh, I didn't really even know this myself. And then he said, we now have the ability, though, instead of doing a drug discovery, plan in 6 months, and this is normally when they fail, it's because of the plan that they put together, we can do it in like a week. So one of the things that will be interesting to see, I think, in the healthcare space now is, will AI, not just in that, but in other areas, be able to help the healthcare space navigate the regulatory frameworks more quickly?
Fantastic. Can we get some closing comments from all the speakers? Because I think that we've covered a broad variety of topics. If you have any things to comment on outside of what you already commented on, that'd be great.
Elliot, why don't you lead us off?
Closing comments.
Yep.
Again, I want to extend my condolences to everybody impacted in California. Thank you, Marty, for hosting this conference. Thank you, everybody, for your wonderful comments and insightful conversations. And if anybody has any questions on how we have generated a 3.1 sharp or outperformed the indexes and are using AI, and I will say we're only halfway through the month, so maybe I shouldn't. So, but we're beating every major market.
Live dangerously.
I know, right? We're swimming in the deep end of the pool and there's no lifeguard on duty here. So, but you're all sophisticated investors. We are beating every major market index by at least 300 basis points year to date. So if anybody's, and thank you, Alan, if anybody's interested, you've got my email and I would love to talk to you. Thank you, everyone.
Alan, why don't you?
And Elliot, we're going to do a podcast for you in February. So, and actually every speaker here will do a podcast with things.
Looking forward to it.
Keep it going, Mark.
Yeah, I'm going to have Alan speak next.
Here's what I would say. aShareX is disruptive innovation. Maureen raised reasonable questions. With any disruption, there's always challenges, but some pretty great opportunity. And I already have heard from somebody today that was on listening saying, well, maybe what you're doing would be good for me as a sponsor. So I think there's some pretty exciting potential for what we're doing. And clearly in the collectible space, it's simpler and we can change some of the way that's done in those areas and partner with a lot of people, which we already are. Thank you. Thank you, Marty.
Thanks, Alan.
Maureen?
Sure. I guess maybe some closing comments. I'm always going to be a big fan of private equity. I think it's just the most active form of equity, and it has the most ability to generate alpha. But I also think that it has the greatest dispersion amongst, different managers. And so that's why I like to always focus on alignment. I think being from a family office perspective, you're more likely to come across the emerging and new managers out there. Many of them don't actually get funded by, I would say, the institutional managers, the pension funds, endowments, or fund of funds. So that offers, I think, an interesting opportunity because many times managers in their first and second funds really outperform than they do in their third and fourth.
Somebody should need to go on mute. Sanjay?
I think Sanjay. There we go.
Much better.
Yeah, and so just the focus on alignment, though, is really key. The focus on alignment. One of the things that I would say regarding family offices from my perspective is that they have different liquidity profiles than institutions sometimes, and they have maybe less avenues to get liquidity than, say, some of the larger institutions. And on venture, while there may be still an excess amount of capital in venture, and I certainly think that valuations, especially on the AI side, are quite high, we have been able as humanity, but certainly here in the Bay Area and in the US, we benefited a lot from our venture communities. And so I'm still a big fan of and continuing to invest in venture because that will be the way for us to generate some amazing companies, even though we probably won't be able to get exits in all 1,400 unicorns, Marty. I agree with you on that.
Well, I have to weigh in on Maureen's endorsement of
Al?
equity. Having worked at Kelso and Goldman Sachs and their private equity stuff, I agree that it's a very attractive space. The only counsel is beware the extension risk and be very sensitive to what liquidity needs you have and your ability to fund contingent commitments for funding. Because a lot of the deals, depending on the particular year that the deals were done, can take a long time to get your money back. And so, yes, the returns are sparkling, can be, but depends on the year that the investments were made, and be careful about overcommitting to.
Hey, I have to. We're transitioning. Alan, I do have a quick question for you. You had posted on your deck that you presented that you were looking for investors, but you're also looking for people to participate in the auctions, correct?
Yes.
Great.
Absolutely.
And do you have to be an accredited investor to participate in the auction or no?
No, that's one of the things I highlighted is for Reg A, it's 10% of net worth. So the requirements to participate are truly modest. And yes, we're looking for bidders, and we have some interesting auctions that we'll be putting on the website going forward, where you can get a piece of some pretty interesting assets.
Marty, I gotta say
Mark?
goodbye because time's up here. I gotta jump onto another Zoom.
Yeah, fantastic. Great.